All right, guys, we're going to talk about tax withholding in this video. Now, there are a few important principles here that we want to discuss right off the top before we dive into some details. Number one, according to the IRS, as soon as you receive income, you owe tax on that income. So that's one of the reasons why when you receive a paycheck, right, your employer withholds taxes and sends it to the IRS. As soon as you've earned income, the IRS considers it taxable and wants you to pay the tax you owe on it. That's why tax withholding exists. So as an employee, W-2, then every time you get a paycheck, some is withheld and sent to the IRS. If you have other income, like self-employed income, for example, or income from investments and things like that, then you need to pay quarterly estimated taxes and at least pay per quarter what you owe the IRS. Okay, so that's an important thing to keep in mind. Another thing is that this only affects income tax. Okay, this doesn't have anything to do with payroll tax or any of the other taxes. It's just federal income tax that we're talking about right here. And sometimes state income tax, right? Because when you withhold, sometimes it withholds some for the state. Depends what state you're in, determines how that works. But we're talking on the federal level at this point. And then tax withholding, the only reason it exists again is because the IRS considers income to be taxable as soon as you receive it. But the whole point of it is just to pay what you owe on your income thus far. And so you want to withhold as close to the amount that you will actually owe as possible. If you end up withholding a lot more than your tax liability, you end up getting a refund. So that's what we'll talk about now. But those are kind of some principles. We want to get our tax withholding as close to our actual tax liability as possible. So there is over-withholding. Over-withholding is where you withhold too much money, or at least more money than you actually will owe in taxes, and send it to the IRS. What this ends up doing is you end up getting a bigger refund, but it happens next year at April, right, when you file your taxes. It puts a strain on cash flow. If you're withholding, an extra several $100s per month, more than what your actual tax liability is, that's several $100s you're sending to the IRS as an advance tax payment that you are not receiving in your bank account to be able to pay off debt or invest or whatever. And so it can put a strain on cash flow by sending too much money there to the IRS. And then it actually makes you wait to use your own money, right? This is your money. And it makes you wait all the way till April when you get a refund. You're like, hey, sweet, I got a refund. It's like, well, that's just your own money. You already earned it. You just had to wait until April to use it again. So essentially, if you over withhold, you are giving the IRS an interest-free loan. You're saying, hey, hold on to this money, keep it safe for me until next April, and then I'll take some back. Okay, that's over withholding. We want to limit that. Now, the flip side would be under withholding. If you withhold too little and your tax liability actually is higher than what you've withheld, you can actually run into penalties. The IRS would say, hey, that's not okay. Now, if you over withhold, pay too much in, withhold too much and then get a refund, they're fine with that. But if you don't withhold enough to cover your tax liability, they can get angry. So you can receive penalties for underpayment of taxes. Now, to avoid the penalty, you must either pay 100% of your last year's tax. Okay, so if you've withheld at least enough, the same amount of what you owed last year in taxes, then that works. Or 90% of this year's tax. So this could happen if, for example, you get a big promotion or maybe you have big commissions come in. You're in way more this year than you did last year, or you have a side income that all of a sudden jumped you up. They're okay with that happening as long as you pay at least the same amount that you did last year in taxes. They can understand, oh, you had more income than you anticipated. Okay, that's fine. They're willing to allow that as long as you pay at least as much as you owed last year, like withhold as least as much as you paid in taxes last year. So if you paid $10,000 total in income tax, if you withhold $10,000 of income tax, even though your income's doubled, if you withhold at least $10,000, they will be okay with that. Now you will owe taxes when you file, right? Because you had double the amount of income. So you'll owe taxes, but they won't penalize you for under withholding because you withheld the same amount as you paid in taxes last year. Okay, so they're okay. They'll give you a year cushion. Then they'll want you to adjust for the next year, obviously. Or 90% of this year's tax. So maybe you've estimated it, you've withheld enough, but maybe a little bit more income came in. As long as you've paid 90% of your liability, as long as you've withheld at least 90% of your tax liability, they'll be okay as well. Again, when you file taxes, you will owe, right? You'll have to send the IRS a check to pay, to cover the rest, but you won't get penalized. Okay, so that's over withholding and under withholding. Optimally, you want to withhold just about the amount of taxes that you're going to owe, maybe a little bit more, just as a cushion, right? So the tax refund, you're not going for a big tax refund. You'd rather have the money in your pocket now, like right now, every paycheck, every week, every month. Now, the way that the tax withholding is calculated is through the W-4, okay? And this form essentially tells your employer how much tax you want withheld, because everybody's tax situation is different. It's not, again, we don't live in a country with a flat tax, right? It's graduated, but there's also a lot of other deductions, itemized or standard. There's a lot of other factors that go into it. So it's not as simple as looking at how much you earn and then withholding that much. So at the W-4, you actually can put in some of those details and make sure that your withholding is closer to what your actual tax liability is. So in a future video, we'll walk through that. We'll look at the form and I'll show you some tools for that. There's an online calculator the IRS has that is pretty handy and helps you understand how to calculate it, especially if there's two incomes and itemized deductions and all that type of stuff. The online calculator is fairly easy to use. But once you understand what you need to put, then with your employer, you can submit a W-4 to payroll and say, hey, here you go, withhold this much. Okay, and they'll adjust your withholding appropriately. Okay, so we'll talk more in detail about that in another video. Now, one thing I hear all the time is, especially people that earn bonus checks or commissions, maybe they're in sales, they're in a big commission check comes in every quarter or whatever. What I hear all the time is, I can't believe how much money I'm taxed on these bonus and commission checks. Okay, I understand where they're coming from, but that's wrong. Bonuses and commissions are taxed at the same rate as all of your other income. The difference is sometimes it's withheld at a higher rate, because this sometimes can be income you aren't planning on. So the IRS wants to make sure you've withheld enough to pay for the taxes, right? If you under withhold and get to tax time and you owe several $1,000s that you don't have and you can't pay it, that is a bad situation. You do not want to be there. And so when these bigger checks come in that are maybe very variable, based on performance or, sales closed, and there's a wide variability there, sometimes the IRS will just say, hey, we're going to over withhold, like even up to 40% of this check, we're going to withhold for taxes, because they want to make sure that you don't under withhold and then don't have the money to pay taxes later. It doesn't mean you're taxed at 40% on that money. Just want to be clear. You're not taxed extra on that money. They're just withholding a little bit extra upfront to make sure that you can cover the tax bill later. When you file and everything shakes out just like the way we talked about, and you find out your total taxable income, salary, bonuses, commissions are all taxed according to that formula that we set out. It's all the same tax rates. They just might withhold a little bit more upfront. And so if you have some of these big checks and they withhold a lot, like up to 40%, you probably are looking at a refund later. Okay, that's just the bottom line. Now, there is a way to get around this. Okay, if you don't want to send so much to the IRS as a withholding, then one thing you can do is fill out a new W-4 just before that pay period. Every employer does this differently, and they have different cycles. So you got to work with HR on this and the payroll team to make sure you do this correctly. But you can submit a new W-4, and one of the options on there is to claim exempt from federal tax. When you claim exempt from federal tax, they do not withhold any federal taxes from that paycheck. So if you have a big commission check coming up, you can submit a new W-4 to payroll, claim exempt in time for it to process for that next check. Then you actually get your entire check, the full check, no withholding. And then you can submit a new W-4 going back to your normal withholding and everything, and submit that to them so your other checks are withheld appropriately, okay? If you do that, you can get a bigger lump sum. You can get all of your commission or bonus check right then and do what you need to with it, instead of having 40%, up to 40% withheld and not being able to touch it until tax time, okay? You just have to be careful. Again, we don't want to under withhold because there are serious penalties for that. So you have to track it and make sure that your tax liability is matching up with your income. I'm going to show you how to do that within the wealth management system, the money dashboard. I'll show you how to look at this because they actually estimate taxes pretty accurately in there. It's not 100%, but it's pretty accurate. You can see how much tax you're slated to owe. And so that's one way to get around bonuses and commissions and things like that, at least the high withholding amounts. And then the last thing is if you are self-employed or have self-employed income, a side hustle, you do 1099, you're sole proprietor, or if you have an S Corp, right, you have an LLC, whatever it is, if you receive self-employment income, then you're not withholding any of that. You just get the gross amount into your bank account. Then you are in charge of sending quarterly estimated tax payments to the IRS. There's an online system for it. You can mail them a check or you can go online and submit a payment. But essentially, each quarter, you kind of have to look and say, okay, well, what's my tax liability on this money? And then send in an estimated tax payment so that you are paying the taxes on the income you earn at least once per quarter. Okay. And then when you file taxes and it all sorts out, you might get a refund. You might have underpaid a little bit and you can sort that out. So that's the way you do it if you're self-employed. You actually directly pay the IRS instead of having stuff withheld from your paycheck. Okay, that wraps up this video. We'll see you guys in the next one.
Take control of your paycheck and keep more of your money.